John Lynch is the chief equity strategist at Wells Fargo Funds, which has $160 billion in assets under management. Earlier this year, he forecast a trading range of 1,000 to 1,225 for the S&P this year. So far, he's been right on the money. So, John, in terms of some of the selling today, that is an opportunity. How come, in your view?
Hey, Carol, I do think it's an opportunity. Anytime the S&P slips below that 1,100 level, we're looking really attractive on a price to book, price to sales, price to cash flow metric. And then in addition, we're looking at about $83, $82 in earnings, operating earnings for the S&P 500 this year. It's exactly where we were in 2007, but only in 2007 we were trading at 18, 19 times that number, and today we're at 12 or 13 times that number. And I think more importantly, we're discounting those earnings at interest rates significantly lower than where they were 3 or 4 years ago. But,
John, even with the worries in the economy and, again, the renewed worries about what's going on in Europe, I mean, nothing new in terms of Europe, but, again, here it is, kind of front-page news in terms of how it's playing out in the markets. So even with those worries, you still see the stocks as being an opportunity here?
I do. When we talked about a sustainable trading range, because we're going to test both ends of it, I'm afraid. And I think Europe's going to be a big reason for that. I think, unfortunately, the sovereign credit concerns will be, if you will, a gift that keeps on giving for investors as different issues surface. Today, it's the validity of the bank holdings of sovereign credit. Why U.S. banks are down is because there's concern about the potential for higher capital ratios to be held at the banks, which also could limit profitability. So we're going to have a give and take, I'm afraid, until we really digest all of this. And it could take another 18 months, quite frankly, for this trading range to really play out.
John Lynch, let me have you weigh in on this. I mean, is this the way to get jobs in your view?
Well, the market appears to be voting no, certainly today. The $50 billion infrastructure, as Mike suggested, if $850 billion didn't get it done, the market's saying, well, an additional $50 billion won't help. I think the bigger issue, and I'm curious to hear what Mike thinks about this, is that, the $200 billion or so that could be saved from the CapEx and the R&D, I think the combination of that ideally can be very effective for corporate profitability, yet the market appears to be concerned that they're going to pay for it through an end around, say, taxing foreign source profits. So I think that's another reason why the market's way down today.